Hey, this is Baird with Simple Wealth, and today I want to talk to you about two different index funds or ETFs that you can invest in for the long term, and one that you can invest in the short term, one that is going to show you bigger returns when the market dips. So what we're going to look at today is we're going to look at a total market fund called VTI, and then we're going to look at another fund that is mid and small caps called VXF. And these are two index funds for killer portfolio. So what's VXF? It's an extended market ETF made by Vanguard. It contains over 3,600 stocks. It's everything just below the S&P 500, but it doesn't include the S&P 500. Since it excludes the 500 largest companies in the United States, its top holdings are a lot different than VTI, and it's actually a lot more diversified than if you bought the S&P 500 index. So what's in VXF? We can see some of the top companies that are in there: Square, Blackstone, which buys up real estate, Snowflake, Uber, Zoom, Airbnb. Most people will recognize these names, but one of the big differences is that these top names in the fund only make up 8% of the assets of the entire index fund. And then if we look at how many stocks are actually in this fund, there's just over 3,600 stocks that make up VXF. They have $115 billion in assets. They're not investing much outside of the United States. And again, only 8% of the portfolio is made up of the top 10 holdings, which makes it a lot more diversified than the S&P 500. So how is VXF spread across the economic sectors? It's more spread across. There's less tech, and there's no huge tech names like Apple, Microsoft, Google, Facebook. It doesn't include any of those. There's more in the communication services side. There's more in consumer discretionary, and then there's more spread amongst the other sectors. So your investment is more diversified than if you buy the S&P 500. So what's VTI? So VTI is an index fund that if you haven't heard of by now, it's one you want to keep tabs on for your portfolio. It's another index fund made by Vanguard, and it invests in the total stock market in the whole United States and contains over 4,100 stocks. It's the most diversified index fund ETF you can buy, unless you buy the entire world, which is ticker symbol VT. So what's in VTI? Well, because it includes the whole US stock market, it includes big names like Microsoft, Apple, Google, Amazon, Tesla, Facebook, now called Meta, NVIDIA, Berkshire Hathaway, and then JP Morgan, and then United Health. And the 10 largest holdings in the whole fund make up almost 25% of the whole fund. So it's a pretty big chunk. And then the whole fund is just over 4,100 stocks are in this one index. So it's a highly diversified fund. So what's in VTI? It's pretty tech heavy. 28% of VTI is composed of tech companies. And then we also have quite a bit of consumer discretionary, and then we're spread amongst other sectors as well. It's going to be a lot more tech heavy than VXF. And it also contains a lot of the S&P 500. It contains all of the S&P 500. Now, where VXF is really going to shine is when the market tanks. So in the last couple of days, we saw the market go down quite a bit, and VXF had a great buying opportunity because it dropped a lot more in the last week and in the last month than VTI did. And in the last year, if you invested $10,000 in VXF, you'd have a just over $1,000 more return in VXF for the last year than if you had invested in VTI. Now, looking at 3 years, looking at a 3-year average annual return, VTI does win by about 0.4%. So that's where that stands. If you're going to invest for the longer term, you probably want to have more VTI in your portfolio, unless you're trying to stay away from those big tech names like Amazon, Google, Apple, Microsoft. 5-year return gets a little tighter. It's still it's just under 0.5% different average annual return. So VTI might be a better opportunity for the long run. And then 10-year average annual return, it gets even tighter. Now we're looking at only 0.5% difference in the average annual return between VTI and VXF. So who has a bigger dividend? If you care about growth, a dividend is not as important and won't have a big effect on the investment because they're both smallish dividends. VTI has just over a 1% dividend, coming in at 1.17% as of early December 2021, and VXF has a 0.5% dividend. If you really want dividends, though, you could be buying SCHD, VIG, or VYM. Those are better funds to go after if you really care about a dividend. So when would you buy VXF versus VTI? The VXF dips in the last year have been larger because it's comprised of mid and small cap stocks. I personally buy VTI every month to build my portfolio because it's one of the most diversified things you can buy. I did buy VXF on December 8th because it's currently down over 5.8% over the last month, giving it room to swing back up when the market recovers. VTI, on the other hand, is only down 0.63% in the last month. So you're probably not going to see as much of a gain over the next 2, 3, 6 months, maybe even year if you're investing in VTI. And just keep in mind that VXF does not contain the S&P 500. That is the big difference between investing in VXF and investing in VTI. All right, so let's take a look at an example comparing VXF and VTI for the last month of their performance. As you can see, VXF is down 8% in the last month. There were some good buying opportunities all in this time frame. I think even right now, this could be a good buying opportunity if we're going to see that Santa Claus rally at the end of the year. If you think the market is going to come back in the next 2 or 3 months, you might have a pretty good buying opportunity right now. I bought in, let's see, 160, 186.78. I bought in right about here on December 8th. So I didn't quite get the lowest part of the dip, but I still got in. If we go over to VTI, in the last month, VTI isn't even down 1%. So if you want to buy those dips, VXF can give you a really good diversified way to buy dips in the market, and you're probably going to see a higher return in the short term when you buy those dips. Excuse me. So anyway, and then if we look at the 3-month, VTI is actually up almost 2.5%, and I believe if we go back to VXF, so it's up. VTI is up almost 2.5%, whereas VXF over 3 months, it's down a little over 4%. So you have some buying opportunity there. Again, because it's made up of mid and small cap stocks, it's excluding the largest companies, the 500 largest companies in the United States. So what's the bottom line with VTI versus VXF? Both of them are highly diversified index funds, which means that they're comprised of thousands of different stocks. VXF had about 3,600 stocks in its fund, and VTI had about 4,100 stocks in its fund. You're probably going to see bigger gains when you buy dips on VXF. Now, you have to keep in mind there is more downside there because mid and small cap stocks sometimes see bigger swings when the economy is not doing well or when the stock market's not doing well. They can go down lower. And then the other big difference is that there's no huge names in VXF. It does not include the S&P 500, no Apple, no Microsoft, no Google, no Amazon, no Facebook, no Tesla. So keep in mind that you're not investing in these companies, and that could be part of your investment strategy, depending on what you're doing. So I just wanted to share that with you today. It's a fund that I just learned about last week, bought it on December 8th. This is not investing advice. This is for informational purposes only. So take from it what you will. And if you enjoyed this video, please subscribe to Simple Wealth on YouTube and smash that like button. We really appreciate it as the channel grows. Thanks for watching. Also, in the link I'm sharing some links in the description. If you don't already have free stocks from RobinHood, go ahead and check that out. And WeBull. You can get free stocks from both of them if you haven't signed up yet on either of their platforms.